Hi, Jim Gore from THOR Wealth Management. In this market update, I'm going to talk about the state of the consumer and is the consumer holding up pretty well. First of all, let's look at this chart here, and this is looking at the personal savings rate of consumers. And what's interesting, this goes back to 1960. From 1960 all the way to about 1993, the savings rate was about 10%. It fell all the way to 2005 to a little bit over 3% that people were saving, and it picked up actually from 2005 to 2020, went back to historical norm of 10%. Some of that might have been baby boomers saving for retirement, but we also saw COVID hit, and you can see a huge jump up to 35% savings rate. COVID hit, we couldn't spend any money, so we were all just putting our paychecks, whatever money we got, and putting it into our account. We were also getting money from the government, and the government was giving us that money, and we couldn't spend it. But now look where the personal savings rate is. The personal savings rate right now is about 5%, so we are half of where we were in 2020. So the consumer is not saving as much money as they have. Part of that is inflation. They are paying more for goods than they were 3 years ago. Another way to look at that is just not the rate. Let's look at the actual dollars that were in savings. And you hear that the consumer has $1 trillion in savings right now, excess savings. Yes, that's true, but they had that from 2015 to 2020. Then COVID hit. We were given all this money by the federal government. They just printed money, and we saw a savings rate go from about $1.5 trillion to $6.5 trillion. So we were all flush with cash, but look at what has happened since then. The savings rate has come down to $1 trillion. So, it's a huge depletion of our savings in our checking account. Has gone from $6.5 trillion to $1 trillion. So we have $5.5 trillion basically that we've spent the last couple of years, after COVID. And looking at that, another way, keep in mind that $1 trillion in savings that's there is not inflation adjusted either. And this chart really has the point, shows the point of what the Federal Reserve actually did in the government by giving us that money. We had M2, which is the money supply. You look at the money supply, we had a huge jump up in COVID. You had 35% increase in the money supply, $6 trillion. They increased the money supply, went all into our savings. We depleted our savings over the last couple of years, but we're still $3 trillion above that trend line. This is why you're going to have inflation for a while. 35% increase in the money supply in a couple of months is going to take a long time to digest that. So the money supply has come down here in the last year, but it's still $3 trillion above that. And we have only $1 trillion in our savings right now. So there's going to be some pressures on our savings in the future, and that's going to come from inflation as they try to narrow that gap by raising interest rates and selling off some of the securities at the Federal Reserve. So let's delve into a little bit more about the consumer, and let's talk about how much they can have to spend. And, I noticed this last couple of months with the nice weather. You go out on a Saturday, the malls are packed. The 3 traffic lights, wall-to-wall traffic to get into the mall just this past weekend. And so is the consumer dry? No, the consumer is not dry. They do have some excess spending power. And that part of that is if you look at their credit cards. This is showing up in the delinquency rates. Delinquency rates were going down, but they actually fell to under 2% during COVID. They were about 1.5%. Now they ticked up a little bit. Now you got to watch that because the tick up can continue higher, but we're at about 2%. So the consumer right now is good. They do have excess money. They're not delinquent on their credit cards, but the trend has reversed and is starting to move up. And we have to, as I said, watch that very closely in the months ahead. But right now, it is not a concern that the consumer is going to be pulling back anytime soon from the credit perspective. Another way to look at that is your credit card balances. You can see from 2014, we increased our credit card balances from about $540 billion to $700 billion. But COVID hit. And what we saw is people took that money, some of their excess savings, and paid down their credit cards. Right now, we're back up to that little bit over $700 billion in credit cards. So the last 4 years, there hasn't been an increase in credit card balances. So that's a good sign. That means that there is some excess cash, and we know that people are using some of their credit cards, especially some of the middle class and lower middle class, because inflation is biting them. They are using their credit card, but still, we're only back to the balances we were before COVID hit. So there's still room to grow here. But this is one of the things we're watching very closely. Yes, we can increase our credit card balances, but the interest rate that we're paying has jumped up dramatically here. And this is looking at commercial bank interest on credit cards. And we've seen that credit card interest rates have gone from 15% to 19%. And that's just in the last several quarters that banks have been increasing their credit card balances. So just that 4% increase on $700 billion is a $28 billion more cost to consumer. So right now they have the excess ability to borrow money and spend it, but this is a short lease. And this is something that we're watching very closely. So over the next several months, the Federal Reserve is going to continue to raise interest rates. Consumers will continue to spend, probably add to their credit card balances, but they will get sometime into the danger zone, but they're not there yet. And this is why the economy is doing very well. This is why you're seeing job numbers, JOLT numbers are still very good, over 10 million job openings right now in the country. So things are not that bad for the consumer, but the trends are starting to look pretty bad, but not bad enough to say, hey, watch out and retrench. So still, we're going to have a couple good months here for the economy. If you have any questions or concerns, as always, reach out to us at THORWealthManagement.com or give us a call. I look forward to talking to you in a couple weeks. Take care.